A man once turned down $10 million in profit because he was afraid of losing 100,000. That single mental error kept him poor forever. And you're making that exact same mistake every single day without even realizing it. You think you're broke because you don't have enough money? Wrong. You're broke because your brain is literally programmed to sabotage you financially, and a Nobel Prize-winning economist proved it. Daniel Kahneman spent his entire career studying human decision-making, and what he discovered will blow your mind. He found that it's not your circumstances keeping you poor. It's not your education. It's not even bad luck. It's something far more insidious: cognitive biases. These are automatic errors your brain makes that drain your wealth without you even knowing it. In the next minutes, I'm going to show you the 5 mental traps that rich people understand and exploit, while 95% of people stay stuck. Number 3 is going to completely destroy everything you believe about money. By the end of this video, you'll understand why you make the financial decisions you make, and more importantly, how to reprogram your brain to think like the wealthy. So if you've ever wondered why some people seem to effortlessly build wealth while you're working just as hard but getting nowhere, this is your answer. Let's dive in. Let me ask you something. If I offered you a coin flip where heads you win $100 and tails you lose $100, would you take it? Most people say no. And that's the problem, Daniel. Kahneman's research on loss aversion revealed something profound about human psychology. The pain of losing $100 is approximately twice as powerful as the pleasure of gaining $100. Think about that. Your brain treats losses and gains completely asymmetrically. This isn't just interesting psychology. This is the #1 reason people stay broke. Here's how this shows up in your real life. You bought a stock at $50 per share. It drops to $30. Logic says you should cut your losses, but instead you hold on, telling yourself you're just waiting for it to recover. You're not making a financial decision anymore. You're making an emotional one. You're so terrified of realizing that loss that you hold onto a sinking ship, often watching it drop even further. Or consider this scenario. You're in a job that pays you $40,000 a year. You're miserable, undervalued, and underpaid. A recruiter reaches out about a position that could pay $70,000, but it's at a new company with some uncertainty. You decline because what if it doesn't work out? You're so afraid of losing the security you have that you're willing to sacrifice $30,000 a year in potential income. That's loss aversion controlling your bank account. Behavioral economics shows that this bias affects everyone. Studies document that investors hold losing stocks 50% longer than winning stocks because selling at a loss feels like admitting defeat. Your ego and your wallet are in direct conflict, and your ego usually wins. But here's what wealthy people understand that you don't. They calculate real risk versus emotional risk. They know that holding on to a losing investment because you don't want to feel bad is not a strategy. It's self-sabotage. Warren Buffett famously said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1. But here's what most people miss about that quote. Buffett isn't saying never take risks. He's saying don't let your emotional attachment to avoiding loss prevent you from making smart decisions. He cuts losses quickly. He doesn't let his ego chain him to bad investments. Rich people have a completely different relationship with loss. They see cutting losses as information gathering, not failure. They understand that the money spent is already gone. The only question that matters is, what's the best decision moving forward? Think about the most successful entrepreneurs you know. They've all failed multiple times. The difference is they failed fast, learned the lesson, and moved on. They didn't throw good money after bad. They didn't hold on because of pride. They made the tough decision to cut their losses and redirect their energy to better opportunities. Here's your practical action for this bias. Right now, pause this video for a moment and ask yourself, what am I holding on to out of fear of loss that I should let go? Is it a bad investment? A career that's going nowhere? Business idea that's not working? A side hustle that's draining more than it's generating? The wealthy understand something crucial: opportunity cost. Every dollar and every hour you spend clinging to something because you're afraid to lose is a dollar, and an hour you can't invest in something better. Your loss aversion is literally bankrupting your future. But here's the hardest truth. You can't eliminate loss aversion. Kahneman himself, after decades of studying it, still falls victim to it. The solution isn't to stop feeling it. The solution is to create systems that decide for you. Set rules before emotions take over. Decide in advance. If an investment drops by 20%, I sell automatically. If a business doesn't hit X revenue in 6 months, I pivot. Remove your emotions from the equation. Because here's the reality. The market doesn't care about your feelings. Your bank account doesn't care that selling at a loss would hurt your ego. The only person loss aversion is protecting is your pride, and pride doesn't pay bills. Let's move to the second mental trap that's keeping you broke. And this one is even more dangerous because it operates completely beneath your conscious awareness. Have you ever walked into a store, seen a jacket originally priced at $300 marked down to $150, and thought you were getting an incredible deal? You weren't. You were getting manipulated by one of the most powerful cognitive biases in human psychology: anchoring. Daniel Kahneman's research on anchoring showed that human beings are unconsciously influenced by the first number they encounter, even when that number is completely arbitrary and irrelevant. Retailers, employers, and salespeople use this against you every single day to extract your money. Here's how anchoring destroys your wealth. That $300 price tag? Completely made up. The store never intended to sell it at that price. They printed it on the tag solely to anchor your perception. Now, when you see $150, your brain doesn't ask, "Is this jacket worth $150? Instead, it asks, "Am I saving $150? You're not comparing the jacket to its actual value. You're comparing it to an artificial reference point designed to make you spend. But the anchoring effect goes way deeper than shopping. Let's talk about your salary. When you got your first job offer, the employer probably asked, "What's your salary expectation?" If you gave a number first and it was too low, you just anchored your own value downward. If they gave a number first, they anchored you to their budget, which was probably the lowest they thought you'd accept. Studies in behavioral economics show that the person who gives the first number in a negotiation has enormous power because that number becomes the reference point for the entire discussion. Everything else gets evaluated relative to it. If they say 50,000 and you wanted 70, you're now negotiating from their anchor, not yours. You might settle for 60,000 and think you won, but you lost 20% of your worth because you let them set the frame. This is why you see people stay stuck at the same salary for years. Their initial offer was low, and every subsequent raise is just a small percentage increase from that low anchor. They never reset the anchor. They never say, "The market rate for my skills is X, and that's my baseline." They accept incremental raises from an artificially low starting point and wonder why they're always behind. Wealthy people understand anchoring, and they flip it. They don't wait for someone else to give them a number. They research market rates, add 20%, and they go in with that number first. They create their own anchor. They say, "Oh, I don't accept offers below X," and they mean it. They know that whoever sets the anchor controls the negotiation. Here's another place anchoring destroys your wealth: real estate. You're looking at houses. One is listed at $500,000. It's been on the market for 6 months, clearly overpriced. But because you've seen that $500,000 number, when they negotiate salary, they don't respond to the employer's first offer. They say, "Before we discuss numbers, let's talk about the value I bring and market rates for this position." They refuse to accept someone else's anchor. When they buy real estate or cars, they research comparable sales data. They look at what similar properties actually sold for, not what they were listed at. They create their own anchor based on data, not on the seller's wishful thinking. Here's your action step for the anchoring bias. The next time you're in any negotiation, salary, car, house, freelance rate, anything, you give the first number, not them. Research the market, know your value, add a buffer, and state it confidently. Watch how the entire conversation shifts. You just took control of the frame. But also practice this every time you shop. When you see a sale, ignore the original price completely. Ask yourself, would I pay this current price if I'd never seen any other number? If the answer is no, walk away. Don't let arbitrary numbers control your wallet. Anchoring is working against you in 100 small ways every single day. Every price tag, Every salary offer, every limited time deal, is someone else setting an anchor to manipulate your perception of value. The wealthy see through it. Now you do too. Which brings us to the third bias. And this one is devastating because it makes you throw good money after bad, keeping you trapped in failing investments, bad careers, and broken strategies. You paid $1,500 for an online course 6 months ago. You've watched maybe 3 videos. It's terrible. The information is outdated, the instructor is boring, and you're getting nothing from it. But you keep telling yourself you'll finish it because I already paid for it. That's the sunk cost fallacy. And it's draining your wealth in ways you can't even see. Daniel Kahneman's research revealed that human beings make irrational decisions based on past investments, even when those investments are completely irrelevant to future outcomes. Psychologists have documented this over and over. We treat past costs as reasons to continue investing, even when logic says we should quit. The money you spent on that course, it's gone. It's not coming back whether you finish the course or not. The only rational question is my time right now better spent finishing this course or doing something else? But your brain doesn't work rationally. It says, I can't waste that $1,500. So you waste hours and hours on a course that's adding zero value to your life. Think about how this shows up in your financial life. You started a business. You've put $10,000 into it. It's not working. Customers aren't buying. The market has shifted. Every objective indicator says this isn't viable. But you think, I can't quit now. I've already invested so much. So you put in another $5,000. Then another. Not because the business has potential, but because you're trying to justify the first $10,000. That's not strategy. That's ego. And it's the reason 90% of businesses fail. People don't quit when they should because they're chained to sunk costs, or relationships and careers. You've been at your company for 8 years. You hate it. The culture is toxic, you're underpaid, and there's no growth path. But you think, I've invested 8 years here. If I leave now, all that time was wasted. So you stay another year. Then another. You're not making a career decision. You're trying to retroactively justify a past choice. Studies in behavioral economics show this pattern everywhere. Investors hold on to failing stocks not because they believe they'll recover, but because selling means admitting the initial purchase was wrong. People stay in bad relationships because they've already invested so much time. They keep going to a gym they hate because they prepaid for the year. Here's what the wealthy understand. Sunk costs are irrelevant. The money is gone. The time is gone. It's not coming back. The only question that matters is, given where I am right now, what's the best use of my next dollar and my next hour? Jeff Bezos killed billion-dollar projects at Amazon when they weren't working. Not million-dollar projects, billion. The Fire Phone? Dead? Amazon destinations? Gone. He didn't say, we've invested too much to quit. He said, this isn't the best use of our resources moving forward. That's how you build a trillion-dollar company. You make decisions based on future potential, not past investments. Warren Buffett talks about this constantly. He says one of the most important questions an investor can ask is, if I didn't already own this stock, would I buy it today at this price? If the answer is no, sell it. The fact that you bought it 5 years ago at a different price is completely irrelevant to whether it's a good investment today. But most people can't do this because the sunk cost fallacy hijacks their logic. They're so focused on not wasting what they already spent that they waste everything else trying to justify it. Here's the brutal truth. Every hour you spend on that failed business is an hour you can't spend on a winning idea. Every dollar you throw at a sinking investment is a dollar you can't put into something growing. Every year you stay at that dead-end job is a year you can't spend building real skills and real wealth. The opportunity cost of the sunk cost fallacy is enormous. You're not just losing what you already lost. You're losing everything you could have gained if you'd cut your losses and moved on. Think about this. If you're in a hole, the first rule is stop digging. But the sunk cost fallacy makes you dig faster because you've already dug so deep, you feel like you can't give up now. That's insanity. Here's your action step. Right now, list 3 things in your life you're continuing only because you've already invested so much. Maybe it's a course, certification program, a business idea, a job, a stock, a strategy that's not working. Now ask yourself this question. If I were starting from zero today with complete freedom, would I choose this? If the answer is no, you know what to do. Cut it, quit it, sell it, move on. I know how hard that is. It feels like admitting failure. It feels like wasting money. But here's the reframe. You're not wasting the past investment. You're preventing future waste. You're freeing up your time, your money, and your mental energy for something that actually has potential. The wealthy don't romanticize past decisions. They don't let pride chain them to bad investments. They kill projects ruthlessly when the data says it's time. They pivot fast. They don't throw good money after bad trying to salvage their ego. Your past investments are tuition. You learned what doesn't work. Now apply that lesson by choosing better going forward. That's not quitting. That's strategic reallocation. Sunk costs have no place in wealth building. Let go of what's not working so you can grab onto what is. Because the fourth bias we're about to discuss makes you overestimate your ability to pick winners in the first place. Quick question. Are you a better than average driver? Most people say yes. In fact, studies show that about 80% of drivers rate themselves as better than average, which is, of course, mathematically impossible. Welcome to the overconfidence bias. Daniel Kahneman's research on overconfidence showed that human beings systematically overestimate their knowledge, abilities, and chances of success. And in finance, this bias is absolutely deadly. Here's how it shows up. You read a few articles about stocks. Maybe you watch some YouTube videos on day trading. Suddenly you think you can beat the market. You start picking individual stocks, convinced you've spotted opportunities that professionals missed. Never mind that hedge fund managers with teams of analysts and decades of experience struggle to consistently beat index funds. You think you're smarter than them, or you have a business idea. You're convinced it's going to be the next big thing. You don't do market research. You don't test the concept with small experiments. You go all in immediately because you're so confident it'll work. Then you're shocked when 90% of businesses fail in the first 5 years, and yours is one of them. Overconfidence didn't just cost you money, it cost you years. Research in behavioral finance is clear. Overconfident investors trade more frequently, take bigger risks, and consistently underperform the market. They think they're being smart and active. They're actually destroying their returns with fees, taxes, and bad timing. The reason overconfidence is so dangerous is because it feels like competence. When you're ignorant, you know you don't know. But when you have a little bit of knowledge, you think you have a lot. Psychologists call this the Dunning-Kruger effect. You've learned just enough to be dangerous, and you don't know what you don't know. Here's what wealthy people do differently. They know what they don't know. They're comfortable with uncertainty. They don't pretend to have expertise they don't possess. Warren Buffett has a famous quote, "Only invest in what you understand." He's passed on countless investments in tech companies because he openly admits he doesn't understand the technology well enough to predict their future. Think about that. One of the richest men in the world leaving billions on the table because he knows his limits. Most people do the opposite. They invest in crypto because it's hot, even though they couldn't explain blockchain if their life depended on it. They start businesses in industries they've never worked in. They make massive financial decisions based on confidence, not competence. Studies in psychology show that experts are less confident than novices because experts understand the complexity of their field. Novices see simplicity where there's nuance, patterns where there's randomness, certainty where there's probability. Wealthy people solve overconfidence with two strategies. First, they test small before they scale. They don't bet the farm on an untested idea. They run experiments. They pilot programs. They validate assumptions with real data before committing serious resources. Say you think you can start a consulting business. Don't quit your job and invest $50,000 in infrastructure. Spend $500 on a basic website and try to land one client. See if people actually want what you're selling. Test the hypothesis before you bet your livelihood on it. Second, they hire expertise. They know they don't have to be the smartest person in the room if they can afford to put the smartest people on their team. They hire accountants, lawyers, financial advisors, industry consultants, people who actually know what they're doing. They don't let their ego convince them they can do everything themselves. Here's the thing about overconfidence. It's not that you're dumb. You're just not as knowledgeable as you think you are. None of us are. The problem is when you act like you have 10 years of experience when you have 10 hours of YouTube videos. Let me give you a practical example. Say you've got $10,000 to invest. Your overconfident brain says, I'm going to pick individual stocks and beat the market. Here's a better strategy. Put $9,000 in a diversified index fund that tracks the market, which historically returns about 7 to 10% annually. Then take that last $1,000 and use it to test your stock picking skills. If you beat the market with that $1,000, great, you've learned something and you can scale up with evidence. If you underperform, which is statistically likely, you've only lost a small percentage while the bulk of your money grew steadily. That's how you manage overconfidence. You test your assumptions with stakes small enough that being wrong doesn't destroy you or take business. You want to start a clothing line. Don't manufacture 1,000 units before you've sold one. Create 3 designs. Run ads, see if anyone buys. If nobody does, you learn the lesson for a few $100s in ad spend instead of 20,000 in inventory. You can't move. The wealthy understand that confidence without competence is dangerous. They respect the complexity of markets, industries, and systems. They don't assume they've cracked the code just because they read a book or took a course. Here's your action. Before you make any significant investment, whether it's money, time, or energy, ask yourself, what do I actually know versus what do I think I know? What evidence do I have that this will work? If I'm wrong, what's my downside? And if you can't answer those questions with data, not feelings, then test small first. Validate before you scale. Experiment before you commit. That's not being timid. That's being smart. Overconfidence makes you shoot first and aim later. The wealthy aim carefully, test their aim, and only then take the shot. Because your confidence should be proportional to your competence. And your bet size should be proportional to your evidence. But even when you have good evidence, the next bias makes you ignore it in favor of dramatic stories and recent events. And that's why we need to talk about availability heuristic. Your friend made $50,000 on crypto last year. He won't shut up about it. Now you're convinced crypto is the path to wealth, and you're about to put your entire savings into it. You just fell victim to the availability heuristic, and it's about to cost you everything. Daniel Kahneman discovered that human beings judge the likelihood of events based on how easily examples come to mind, not on actual statistical probability. If you can quickly recall something, because it's recent, dramatic, or emotionally charged, your brain assumes it's common. And that assumption destroys wealth. Here's how this works. You see a news story about a plane crash. Suddenly, flying feels terrifying, even though you're statistically safer in a plane than driving to the airport. Why? Because the plane crash is vivid and recent in your mind. The thousands of safe flights happening every single day don't make the news, so they're not available to your memory. Now apply that to money. You hear about someone who got rich flipping houses. You don't hear about the 100 people who lost money trying the same thing, because they're not posting about their failures on Instagram. Your brain only has access to the success story, so it overestimates the probability of success. This is called survivorship bias, and it's a specific form of the availability heuristic. You're only seeing the survivors. The failures are invisible, so you think success is more common than it actually is. Studies in psychology show that people overestimate the frequency of dramatic events and underestimate common ones. You think shark attacks are a major risk because they make headlines. You underestimate heart disease, which kills magnitudes more people because it's not dramatic. In finance, this is catastrophic. You see viral stories about people quitting their jobs to do crypto day trading. You don't see the 95% who lost money and quietly went back to their jobs. You see the TikTok star making millions on a dropshipping business. You don't see the 10,000 who tried the same thing and made nothing. The availability heuristic makes you chase fads. Whatever's hot, whatever's recent, whatever you've heard about most recently feels like the opportunity. Meanwhile, boring, proven wealth-building strategies, consistent investing in index funds, building real skills, starting businesses with actual market demand. These don't feel exciting because they're not available in your feed. Here's what wealthy people do. They make decisions based on data, not anecdotes. They understand that the plural of anecdote is not evidence. One person's success story tells you nothing about your probability of success. Before investing in anything, they ask, what does the aggregate data say? What's the actual success rate? What do the statistics look like over time? Not just in this hot moment. Let's take real estate. You hear stories about people making a fortune flipping houses. That's available. What's not available is the data showing that after costs, most flippers make less than minimum wage for the hours they put in, or that housing markets are cyclical, and the people you heard about got lucky with timing. Wealthy investors look at historical data. They see that over decades, real estate appreciates roughly in line with inflation. It's a decent wealth preservation tool, but not the gold mine the availability heuristic makes it seem. They invest based on that reality, not on stories. Or take entrepreneurship. You hear about the startup founder who sold their company for $100 million. That story is available. What's not available is the data showing that only 0.4% of startups ever reach a $10 million exit, let alone $100 million. The wealthy know these odds. They start businesses, but they do it strategically, with realistic expectations and backup plans. Here's where this gets personal. A family member or friend comes to you with an amazing opportunity. They're so excited, so convincing. You think, if they believe in it this much, it must be good. Wrong. Their enthusiasm is affecting your judgment because their emotion is making the opportunity more available in your mind. Research in behavioral economics shows that emotional intensity increases availability. The more dramatic the story, the more weight you give it. That's why scammers are always excited, always urgent, always creating emotional momentum. They're hijacking your availability heuristic to override your logic. What do the wealthy do? They say, that's interesting. Send me the data. Let me research it independently. Give me a week. They don't make decisions in the heat of the moment when availability is highest. They step back, look at statistics, and compare the opportunity against historical base rates. Here's a powerful question wealthy people ask. If I'd never heard this specific story, would I still think this was a good idea based purely on the data? If the answer is no, they pass. Think about the financial crisis of 2008. For years before it, housing prices only went up. Everyone had stories of people making money on real estate. The availability heuristic convinced millions that housing was a can't-lose investment. Then the bubble popped and millions lost everything. The wealthy who survived. They looked at historical data showing that rapid price increase is always correct. They didn't care that everyone around them was winning. They cared about what the statistics said about sustainability. They were willing to look boring and miss out on short-term gains to avoid catastrophic losses. Here's your action step. The next time you're excited about an investment or business opportunity, especially because of a story you heard or saw, do this. Find the statistical success rate, find the historical data, find the base rate for that type of venture. If you're looking at crypto, research what percentage of crypto investors actually make money versus lose it. If you're considering a franchise, find out what percentage fail in the first 5 years. If you're thinking about day trading, find out what percentage of day traders beat the market after fees. You'll discover that in almost every case, the data is far less exciting than the stories. That's why the stories are popular. They're outliers, but you don't build wealth betting on outliers. You build wealth betting on probabilities. The availability heuristic makes you feel like you're missing out. Everyone's getting rich except you. That's not reality. That's your brain being hijacked by dramatic, recent, emotionally charged stories that aren't representative of actual outcomes. Wealthy people are comfortable being boring. They're comfortable investing in strategies that don't have viral success stories. They follow the data, not the hype. And over decades, they build real wealth while everyone else chases the next available story. But here's the meta lesson that ties all 5 biases together. And this is the most important thing I'll tell you in this entire video. Daniel Kahneman spent 50 years studying cognitive biases. He literally won the Nobel Prize for this work. And you know what he admitted? He still falls victim to these biases. Think about that. The man who proved these biases exist, who understands them better than anyone alive, still gets tricked by his own brain. So if you think watching this video means you're now immune, you're wrong. That belief itself is overconfidence bias. The solution isn't to eliminate these biases. That's impossible. Your brain is wired this way. Evolution programmed these shortcuts because they helped our ancestors survive. They just don't help you build wealth. The solution is systems. You create rules that decide for you so your biased brain doesn't get a vote. Wealthy people don't rely on willpower or awareness. They automate good decisions. Investment goes automatically from your paycheck into index funds. You never touch it. You don't get to make emotional decisions about whether the market feels right. The system decides. You set rules in advance. I sell any stock that drops 20%. I exit any business that doesn't hit revenue target X within 6 months. You don't wait until you're emotional to make the call. You pre-commit. Pilots use checklists because even with years of experience, human memory fails under stress. Surgeons use checklists for the same reason. Why don't you use checklists for financial decisions? Create a decision checklist. Before I invest, have I researched the base success rate? Have I tested this idea small? Do I understand this well enough to explain it to someone else? Have I consulted someone with more expertise? Your biases can't sabotage you if you remove your ability to act on them in the moment. That's not weakness. That's intelligence. All right, let's recap what we covered. 5 cognitive biases that keep you broke. First, loss aversion. You're so afraid of losing that you won't take smart risks or cut bad investments. Second, anchoring. You let other people's numbers control your financial decisions instead of setting your own value. Third, sunk cost fallacy. You throw good money after bad trying to justify past mistakes. Fourth, overconfidence. You think you're smarter than you are and make bets without testing. Fifth, availability heuristic. You chase stories instead of following data. If this video gave you clarity about why you make the financial decisions you make, hit that subscribe button right now. We're diving deeper into behavioral finance and the psychology of wealth in every video, and you don't want to miss what's coming next. Here's the bottom line. Kahneman proved that you're not broke because you don't have money. You're broke because your brain is programmed to work against you financially. But now you know. You understand the invisible forces shaping every financial decision you make. Remember, these mental shifts are necessary but not sufficient. Your circumstances matter. Systemic barriers are real. And not every problem is solvable through mindset alone. But within your reality, these biases are either amplifying your struggles or they're being managed strategically. That choice is yours. Your challenge for this week. Pick one bias that hit hardest and implement one system to counteract it. Set up automatic investing to beat loss aversion. Create your own anchors for your next negotiation. List 3 sunk costs you need to abandon. Test an idea small before you scale, or research base rates before your next investment. Drop a comment below. Which of these 5 biases did you recognize most in yourself? 1, 2, 3, 4, or 5? I want to know which one resonated. You're not a victim of your brain. You're a strategist who now understands the game. The wealthy aren't smarter than you. They just know the rules. Now you do too. Go build something real.